The best deals are the best deals.
Yes.
Meaning the best location, the best quality always end up being the best returns. So I love seller carry. I'd say actually right now is a great time to just send those offers. Just send them.
As long as you can preserve and steadily grow people's capital, you will maintain a base of investors that will stay with you for a lifetime. There are real estate investors that are okay with a 12% return.
And I think what's beautiful about real estate is the wealth is generated over time and you have to be patient. It's the old adage, I should have bought more and I should have sold less.
Yeah.
Welcome to another CashFlow Quest. We're excited to have another panel. We want to be the front runners of information when you're talking about manufactured home communities. And there's some newsworthy elements that we bump into. There's a ton of news right now, especially. And so we have some fun things we want to kick around on the news related topics with real estate in general, kind of some things that are transitioning, but also some like just core standard practices that we wanted to dive into within the real estate investing landscape. And so we want to add some value where we can and dive into it. So, all right. So
what were the top searches on Grok or any of these models that you were looking at that people are asking questions on, and maybe we could add some value to some of the listeners?
I think one of the first ones was like ROI. How do you find a property and
find
calculate
a deal that works? Right. That is the magic question. I think that at the end of the day, it goes back to the old location first. You know, you pick your market. And I've heard that from some of my mentors and people that I follow and have looked up to over the years. And it's held true across all of the multifamily, mobile home park, manufactured home communities that we've owned and operated. The best deals are the best deals. Yes. Meaning the best location, the best quality always end up being the best returns. And it's like you want to like create a value and do value adds, but it's not easy to do value adds. And so sometimes you're better off starting with more of a vanilla deal that isn't going to be a home run. Everyone's trying to hit homers all the time. So I feel like that's the big question. It's like Ben and I, you and I kicked around the rule of thumb for like
the 1% rule that people kind of look to. And so there's no 1% rule in San Diego or California, unfortunately. So 1% rule is essentially 1%. You get 1% of the monthly rent compared to the purchase price. So an example, if you rent a home for $1,000 a month, you should pay $100,000 for the purchase price. And that's just been a back of the envelope standard. It goes back into the old days, that 1% rule. And you and I were kicking around like, all right, how do we find deals in mobile home parks? And we're like, oh my God, we've done a couple of deals recently that hit the 1% rule on the dot, but it's really tough. And I think why it's so tough in California is just because purchase price on homes, if we just think about single family rentals, like someone's starting off, like usually you're going to go and buy a single family rental. Right. Like that's what you're going to do first. And in San Diego, the median home price is, I don't know, $1 million. So you need to rent that for $10,000 a month. Like there's just no deals that do that. But you can go, like you're saying, markets. Maybe you go to like Knoxville or some of these up and coming markets and you could find those good deals because they haven't seen that, torrid price appreciation on the homes.
Yeah, the cap rates are still relatively simple and normal, and you can still make a spread above what debt's costing you.
Yep.
So another rule of thumb is 2%, from your cap rate to your interest rate. So like if you're buying a 6 cap, you want to borrow money at 4. Yeah. If you're borrowing money like today, it's 5.5, let's say 6 to 6.5 on a normal kind of multifamily deal, or even what's a home loan? 6.5, 7 right now. So then you'd want to buy an 8 or 9 cap. So that's where the tough piece comes in. So then what you're hunting for is not like there's a lot of push to go into like zero down and find like these ways to cleverly step into homes that have loans where they just got displaced or they took another job and they need to leave and they're upside down their house. And like, I love the Pace Morbies of the world because they do a huge value service to people, training, going out there and shaking bushes for deals. And I agree that if you get into that, you should just go focus on it. But I've found in multifamily that to be a pretty challenging kind of unicorn quest where you might end up in some Timbuktu town. It's hard to find those deals, and big metropolitan locations are very rare. So what Pace Morby did was he built a deal generating machine, a deal mining machine to find those little, unicorn deals all over. And he finds ways to step in super low down. But then Pace Morby also raises a bunch of money.
Yep.
So there's ways to do it, but I would say you're better off to focus in major metros, pick your top 5, then pick your top 1 or 2, go super deep and know and understand the underwriting. And then you'll find that, okay, now I know this market so well that I know that this mom and pop are $200 under the rent.
Right.
And you get closer to that 1%. Let's say in Phoenix, if you buy some older apartment for $100,000 a unit and you can get $1,000 a month, but maybe they're at $750 right now. And so there's a value proposition. Just right now you can raise the rents there, or by going in and doing a little bit of a cleanup. And so that's what we find all the time in mobile home parks.
Yeah. I feel like that's our sweet spot.
And that 2% rule that you're talking about, like we all talk about this all the time. I love deals where if you go in, let's just say that the debt for commercial property right now is probably with Fannie or Freddie, I don't know, 5.5, right? 5.5%. But if you go in at say like a 5 cap, right? And that's what you're buying. So you're negatively levered on the deal. But if you're saying in that example, you're under rented and you know that you're not making a guess on where rent growth is going to be, but you're getting
forma. This isn't projection.
Yeah,
this is like the market comps today.
Comps.
Yeah.
And the current rents are way below.
Yeah.
And then, and so you could say, okay, if I make this assumption that, in the market, things are about 95% occupied. I'm looking at all these comps that are similar quality and these are where the rents are. Then you do a calculation to market cap, meaning you then just you keep your expenses, maybe elevate them a little bit, but then take your revenue, your new rents at that occupancy. And then if you get that spread over that debt, right? So say if you're at 5.5 all in, if you mark to market at a 7.5 cap in year 2 or 3, that's a great deal.
It is.
All day long.
Yep.
And so it's a little bit of pain on the upfront. You're probably not going to cash flow or not cash flow really much, but if you could say, look, I'm buying a great deal today that I know with some certainty that is going to perform and be at a 7.5%, cap rate. That's a deal I'll do all day long. And most sophisticated real estate investors will do all day long as well.
Yeah. And then you're working. So then that leads into financing strategies, which is another question. Question about funding are huge. People ask about leveraging mortgages, using creative financing like seller financing or hard money loans, or even tapping into home equity. They're keen to understand how to minimize upfront costs while maximizing returns. So I love seller carry. I'd say actually right now is a great time to just send those offers. Just send them.
Because you just don't know what the receiving person is going to say. I mean, it might be a great deal. It might be a tax play for them. You just never know right now, especially.
There's a big discrepancy between what sellers really want and feel that their property's worth versus what buyers are willing to pay if you take a standard loan product. So if you can make an offer that works for you, make it initially that really works good, even lean a little heavy on your ask on like a super low down payment and a super cheap rate. We're looking at a deal right now where we might get the deal done with like 25% down, 3% interest only for 5 years. And then it starts to step up through years 10. So we make the offer. And then if it comes together, it's a great deal. It gives us the opportunity. It cash flows well day one. So that's where just continue to be in the market and then make offers with what works.
Yep.
And like another strategy that we're doing for the listeners that, if they wanted to do this as well, is make multiple different offers. So we'll send 3 different offers with different terms, different purchase price.
A, B, C.
Yeah. Get creative, because you never know what's going to be a driver. Usually sellers aren't going to tell you everything. And so you just lay it all out for them and then they could weigh it and then come to you with some questions, or maybe it's the purchase price that they're really hung up on. Maybe they don't want to do seller care. They just want to get rid of it. They're willing to take a smaller purchase price,
right,
or whatever it is. But you should always try to be as creative as possible.
Well, so that you can figure out what their motivator is to get, that information. So you make them the best offer that they want.
I also think with unsolicited offers too, a lot of times when we're dealing with mom and pops, they're not as engaged with the market. So they don't necessarily know where they're actually standing in that moment. And by explaining through a few different options, they're kind of seeing the full picture where they're not offended by a one-off ask that is using real terms, because they've been told for the last 3 years their property's worth more money from all these brokers.
Right.
Now they're kind of seeing, oh, I see how they're kind of calculating and what they're looking at from a debt standpoint. And it's more of an upfront thing. It's like building a relationship out the gate, I feel like.
Yeah, we did that a few months ago. We sent an offer. I'm just going to use different numbers just to make sure nobody can catch what deal I'm talking about. But we sent a $50 million offer, seller carry, 3% interest only for a period.
Yeah.
We sent option B as we just did 2 because we were actually trying to paint the picture of like, guys, your deal is only worth $40 million. So we sent $50 million with a 3% IO carry, seller carry for 5 years. And then it stepped up from years 5 through 10. And then a $40 million, $10 million less at current rates because it needed a ton of equity in order to get a 6%, 5.5% loan today, where the rents were today and the income and the performance of that asset today. It was a $10 million swing.
Yeah.
And then we could have them carry more. So the loan to value is significantly more on a seller carry in that pitch, to where our equity was reduced. So we could lean in and pay $10 million more, knowing where we could get rents. And that one was a funny, crazy swing. But what it did was it shoved them off the edge of their decision, and they ended up selling it for like $42 million.
And that's just such a good point. Like when you bring that up, and someone's like, that doesn't make any sense. Why would you pay $50 million when it's really worth $40 million? They're $40 million and they're just giving you like, a seller carry deal, but it's the time value of money. And that's how debt impacts asset prices, whether it's real estate or stocks or whatever it is, bonds, especially obviously. But that's why people need to understand that when interest rates go up, all else being equal, valuation should go down.
Yes.
At the end of the day, it's all about structure.
Yeah.
And we've heard some mind-blowing deals that were extremely expensive, but because of their structure, they were able to get like a 10 IRR on these cherry Class A assets. And that would normally not yield a 10 IRR. That's a big threshold for Class A, perfectly located product.
Yep.
Yeah.
So I guess just quickly to kind of add to that, just to get your guys' opinion, if someone was going to ask like, what, in your opinion, is the best structure for a deal?
Yeah. Who give us a hypothetical person who's asking the question?
Yeah. Somebody who's willing to raise private money, but then also wants some debt. But what's the ratio that you would really kind of like, is there a happy medium to get the best return, or just depends on market? Just to ask, coming from a
so you're asking from somebody that wants to put in structure deals, raise equity and buy real estate deals and become a sponsor long term.
Yeah.
And then it's really about your ability to assess risk and your pain tolerance and how much risk you're willing to take and how much money of other people's you're willing to lose. And that's what it boils down to. Like,
yeah, I would agree with that.
And so I would never give somebody advice to go take super high debt. We never did. We obviously have had loan to values float up and down over the years. We took 3 floaters that ended up a complete disaster. We ended up getting out of them, but they were no fun. And so we got super lucky, and I'd say even blessed, to have the rent growth and the top line gross revenue increase to where we could get our net operating income up to refinance out of those when interest rates ran on us like crazy.
Yeah.
And those deals started at like 2.3% interest deals, and they ran up to like 7.
Yeah. Which
in 2 years.
2.3 is really desirable. And like
the deals, if they were to stay there, they'd be singing.
They would. But to your point, it's like that risk level, right? It's like, are you worth risking the 2.3 rate going to 7 and totally blowing your numbers and your pro forma? Or do you just settle in the middle and have the certainty of that to then kind of build? And so I don't know, there's so many ways you can structure a deal.
Our recommendation would be to take as the best rate. You could take max leverage that is real, that's not bridge debt, that's not based on a pro forma. Take real fixed rate debt that's based on income today, or what it's going to be through your closing, real actuals for the last trailing 3 or 12 months.
Yeah. And really try to leverage
and just focus on getting a good fixed rate
yes.
and doing your job to minimize the cost of the debt
and raise the additional cash to bridge the gap.
Yep.
Yeah.
And I think too, just like going with a vanilla deal, I think a lot of people get caught up like on the first deal that they need to perform and show these 20 plus return, like track records and like metrics. So all the folks, like it has become a little bit saturated just with how many folks are starting funds or getting into real estate and doing like multifamily primarily. And I look at their pro formas, and it's like 20%. I'm looking through some of their assumptions and it's just aggressive. And I think they'd be way better off if they just took a really conservative approach, just hit some base hits, right? And then maybe the market swings on you in a good way,
right?
And you outperform and you look like a rock star.
Exactly.
But as long as you can preserve and steadily grow people's capital, you will maintain a base of investors that will stay with you for a lifetime. Yes. As long as you have good communication skills and you're really driving the value to them, being a thought leader or being someone that is on top of it when they have questions and really knowing your stuff, people are going to trust you.
Yeah. And I agree with that because they'd rather see that than, them being sold a grand slam or a home run. They just want base hits, something conservative. They know that their money is going to be earning good interest and growing. Doesn't need to be a grand slam every time.
Here's a mind-blowing thing just for some listeners. There are millions of investors out there, real estate investors that are okay with a 12% return. Yes. That's all they're looking for. We talk to them all the day. Oh, 12%. Oh, on your pro forma, that would be perfect for me. Yeah. And it doesn't need to be the 20%.
Well, and most of these guys that you're going to get are wanting to be passive and they're cash flow focused.
Right.
So unless they're young and they're worth a lot of money and they're trying to really spool up their total returns or total net worth, but a lot of our investors are not looking for huge home run returns. They want the consistent cash flow that's secure and safe, best you can be. And they have tax incentives. Yeah. And it's like, it's a good chunk of their portfolio. And then they have other holdings and it's a good way to spread it out to where I think when you're starting, you try to swing for the fences.
Well, I think that in real estate, we live in this world where everything's so fast paced. People want quick money.
Right.
And I think what's beautiful about real estate is the wealth is generated over time and you have to be patient.
Yeah.
So if you have this mentality of like, I want to get rich overnight and do these deals, I think that you're looking at this investment class wrong. Is there ways to do that? Are there opportunities to make quick money? Yes. But if you're syndicating and using other people's money, I think you're missing the beauty in our craft.
Or even just as an investor. I agree with you. I was just having this conversation with a buddy who's a commercial mortgage lender. And we were just talking about real estate. And we had that exact same conversation that too many people get into real estate for the wrong reasons. I think flipping houses, if you're just trying to look to just like get like these little pops, which that's not what I like because you just get hammered with taxes and there's a ton of stress and you're working so much.
So that's like basically becoming self-employed and becoming your own boss and working really hard over and over and over.
Yeah. Which can work. Right. But if you're in real estate, it's the long game and it's that way for the sponsors too. So if you want to start a fund or do anything like that, like you are going to be broke for a while.
It's the old adage, I should have bought more and I should have sold less.
Yeah.
Well, this is a really good point on the structure and I'd say calculating returns and everything. You want to start with the target of where you want to end up in mind. If you don't want to be a flipper and be a contractor, basically a GC that you're just constantly managing construction projects,
managers,
then what do you want to be? Right. What do you want to do? How do you envision your life?
How much do you
we've
really
talked to a lot of our
end?
mentors, like where do you want to take it? If you want to end up with a bunch of multi and like a bunch of class A, it's like, okay, go model them. Go model the people that have done it well. At the end of the day, you're going to have to become a professional at that. It's going to be a 10-year ball game before you show meaningful wealth. But out 10 years, you're going to realize like, oh, wow, I know what I'm doing now.
Yeah.
I was watching a Mr. Beast video, which is like one of the number one YouTubers. And he goes, you don't need my help. Just make 100 videos and you'll know what you need to do. And so
you'll get the feedback.
Just go do deals with
experience.
Cash flow in mind, where you want to be a sponsor and you want to bring value to investors by operating the deals, putting the deals together, structuring them, managing that whole workflow. That's creating value because it's not easy to do.
Right.
So focus on the end in mind that you want to end up with wealth, not just cash. and, income from flipping and from profits or capital gains. You want to end up with ownership in these assets that you long-term can basically have huge residual income and cash flow.
And if you're just getting into it, we talked about this on our last podcast, don't get so obsessed with the size of the deal. There's these guys that have been wanting to buy their first deal for 20 years, but because they never found the 100 space or 200 unit that worked for them, they never bought. And there's a lot of great deals. I see these great cap rate deals that come across all the time that are smaller. And when you're looking at it from a perspective of this, I want to create wealth over the next 20 years, those look a lot better to you. You start realizing, oh, that's a great chip. You could pick up a few of those. Like cash flow takes time. I feel like if you're doing it the right way. I think my first distribution check was like $56, so it took time. It took a decade, and now it's a different animal. And also looking back, hindsight, like I'm kind of glad I went through that process and earned this cash flow and understand how to use it. And it came from blood, sweat, and tears versus if I got it overnight, would have been a different thing.
And I'm sure you don't appreciate it quite the same.
Yeah.
Well, and you can't replicate it.
No, you can't, because you didn't live in the trenches to figure it out, to then know what to do and what not to do and build it again or continue to build it. Yeah.
Really good. The real estate quote I think you're talking about is, you don't wait to buy real estate. You buy real estate and wait.
Yes. Yeah.
And then there's something that comes to mind is like a Dan Pena, like super aggressive. Like he's talking to his guys, just cussing them out that they're going through his training. And he shows this video and he's like, see this is all you. And he's calling them all sorts of names. And it's a bunch of lions lined up and the wildebeests are running by. And he's like, wait for it. I'm about to show up. And then out of like another angle of the screen, this just huge male lion just comes crashing through the other lions and just runs right into the herd, gets trampled, grabs one wildebeest by the neck, pulls it out and walks off.
Like, boom,
and it's like,
got it.
If you're going to do a deal, just do the deal.
Yeah.
Action is better
you'll
than
never
inaction,
learn if you don't get out there and take something down.
And being persistent. Like we always, I don't know how you're constantly making offer after offer after offer. And it's like, you're not going to get every one. So you just being persistent over the years, I feel like has been a huge player kind of in our court, because it's just like, you have to keep trying. You're going to fail. It's part of how you learn. And the persistence of that is really,
now we have our strike zone in our head so sound that when they pop up, it's like, you almost have to get out of our way. So wait, okay, let's jump back in. I want to stay focused. So we could touch on, I do think we throw around cap rates and interest rates and things really quickly. But one of the main things was calculating returns. There's a lot of interest in just the nitty gritty, quick numbers and understanding like cash on cash, return on investment, how to factor in vacancies, repairs, property management fees. They often want a step-by-step breakdown of real world examples to make it click. You should start with like a 10 or 20 unit and go get it somewhere else in a good Texas or Arizona market somewhere.
Yeah. Like if you're looking at a 20 unit, there's going to probably be a broker involved because that's a commercial property. They're going to have some sort of financials for you to underwrite. And then it's your job to then take those financials. Hopefully you have a model. If not with AI, they could just build you out a simple model, right? And it will just run it all for you. But you want to, where the rubber meets the road is all in assumptions when you're underwriting. That's your biggest indicator of if you're a good underwriter or a bad underwriter. It's like, what's your assumptions and how conservative or aggressive are you being in order for you to then get to this evaluation of being the purchase price that you're willing to buy. So your purchase price is really what starts everything, right? Or what ends everything. It depends on how you're underwriting. But say like, the deal will get done at $5 million, right? Then you need to start there as your purchase price and then forecast out based on how many years you assume to hold it. You need to start forecasting out a discounted cash flow model to see what your IRR is going to be.
So then like what's a cap rate? Or I think I could drive this one home. Like if you were to pay cash for that $5 million deal, the net operating income would pay you a 5% return.
Yeah. It's just a current yield on investment is the easiest way to think about it.
Without debt.
Right.
Yeah. So if you buy at a 5 cap without debt, you buy a property, it should yield you a 5%
$250,000
cash on cash.
Yes.
Right. And so what's cash on cash? It's essentially your yield, right? It's similar to like a dividend.
So the IRR is internal rate of return.
Yep.
Just for clarity.
And then I think too, it's like IRR gets thrown around a lot, but just honestly, in real estate, like if you talk to real estate guys, they're like, I don't look at IRR. Like who gives a crap?
About cash flow.
It's about cash flow. Yeah. But you want to calculate your ROI or, based on
what's the return on investment then? So like what we said, the cap rate is another way of saying your return on investment on a $5 million deal. A 5 cap is $250,000 return
5%.
annually on the $5 million.
Starting.
So your rate of return that year is a 5. Then you're going to look at, okay, expenses are, let's say, fixed plus, like we've been 3%. Recently doing like more like 3 to 5%, depending on what's going on, where it's at with insurance. And then from there, you're growing your top line revenue with just maybe standard rent increases. Maybe they're cheap. Like we said, you got like $750 rents going to $1,000, and you have a couple $200, $250 worth of first 2 years, you can really step up percentage wise. So you model that for a couple years at whatever that is, 10%.
Yep.
$75 a year. You'd get there in 3 years. So you can take that. Then your model steps down to more of like a 3.5%, 4% increase in your top line revenue and your rents. That in the end, over 10 years, your net operating income grows substantially.
Exactly.
And then you put a cap rate on that again, and that can give you your value. Depending on what interest rates are, your cap rate could be maneuvering a little bit. And that's where everyone bangs us up on assumptions. Yep. Is what are you using for an exit cap rate? Because that's how you can engineer the deal if you're not careful, and you don't want to be using too aggressive.
Exactly. And it's just, you carry all that forward, right? So you're carrying across your revenues, you're carrying across your expenses, you're deriving a net operating income, and then getting to a terminal value, you just divide that net operating income by a cap rate. And whatever the cap rate you choose, that will then give you your terminal value, right? So then you take just very simple math, new minus old divided by old, right? So you got your new valuation plus all the cash flow that you received during that time, minus what you bought it for, divided by what you bought it for, divided by the number of years you held it. Yep. Now you have an average annual return. That's the return that you made per year, per annum. And it's as simple as that. Like real estate couldn't get more simple. Like it really is. But people make it really complicated with IRRs and like I understand that stuff. So it's like, and you guys all do. So like when I'm talking to quants or people that are analytical or private equity guys, like, yeah, I'll get into the numbers, IRR, all those different assumptions. That's fine. But like
when we brought you over to the private side, I was like, shh, quit talking about IRR. Yeah. Like nobody, like when you're holding stuff long term, it's like it really it doesn't work good for anything past like a 5-year hold. No. So then it motivates everyone in the IRR realm to turn and basically flip deals. A 3 to 5 year hold on a multifamily asset is very fast. Yeah. 3 to 5 years goes fast when you're doing these big construction projects and renovations, to where I think it's silly, not to mention you're getting them to where they're just going to start really being a good long-term asset. You've done all the work. You've groomed it. You got rents to a peak.
And then you get rid of it.
And you go do it all again.
Yeah. And you gotta go do it again. It's like, well, then you need to, we'll do another video on deal structure and how we differ from a lot of shops and don't do pref returns, because we don't, with mobile home parks specifically, there's no new product coming online to speak of. It's like super low volume to where we don't want to have to sell everything we buy. Well, so we changed our structure.
Yeah, it becomes more of a fund structure instead of, an individual property. So that's for another video we can dive into the nitty gritty.
It causes you to sell.
It does.
You know, if you have to turn that to make the profit and the gain versus just focusing on the cash flow model.
And being IRR driven, like funds, they're mostly hitting IRR targets. So then you're forced to kind of sell and move product.
Everyone's incentivized.
Right.
And all the reason why it's like, why if someone's IRR driven, why would they be forced to sell when they just keep holding it? It really comes down to the waterfall structure, the relationship between the GP or the general partner and the LP. And I won't go into it, but there's a
major incentive for the GP in that situation to
sell it early. It drives up a higher IRR because it's a time value weighted metric.
Yes.
And so the higher the IRR, the more money that then starts to flow through a waterfall to the GP. So I won't. I'll stop there.
It's kind of like grading on a curve.
Yeah, kind of. Yeah.
It looks at it kind of skewed if you're just talking cash flow.
Right.
Yeah.
In a lot of the groups that are doing that type of model, the people controlling the asset, it's actually not their money usually. Like it's a fund manager who's like running this whole deal and that's their focus. Mm-hmm. So they're getting fees. They're incentivized to trade deals too. There's a whole business behind that that's influencing that constant turn.
Mm-hmm.
I'll tee up Jen and Tide on this one. Managing risk. People worry about the downsides, tenants thrashing the place, unexpected expenses, market downturns. They ask for straightforward strategies to mitigate these, like screening tenants, building cash reserves, or diversifying across properties, different locations.
Mm-hmm. Well, I mean, there's a lot there, but there's things you can do. Specifically, depends on what asset class you're in, whether it's single family homes, or we've been talking a lot about small apartment communities like 10 or 20 units. There are property management companies that you can hire if, because that is a whole nother sector of this. And if you can hire a property management company, do, because it just helps from a management and the day-to-day of tenant, tenant interaction and communication, rent collection, maintenance items. There's always going to be work orders to fix and maintenance items to do. So if, you have to pick your focus.
Your recommendation would be to hire a third party?
Mine would be.
If it was,
if you're starting,
I think I could argue both sides of this.
Yeah.
I mean, we thought about this really long and hard when we started, and we liked managing our own because we raised money in our structure.
Well, we didn't have any money.
I know.
We had to make a living on the management.
And in our space, there weren't a ton of options for property management companies. Now, if you're in the multi with apartments, there's way more options for property management.
I still think I would argue though that you don't learn that way. Now,
true.
If you wanted
agree
to
with that statement.
If you wanted to hire one, knowing that you're eventually going to take it over, and or try to make friends, go to industry events, try to learn and make friends with management companies to where you could say hey, what do you think about this? What do you think about that? You can learn best practices.
Do you think it would be different if we were in the multi-space, like apartments?
Maybe, but my biggest thing there is so that it leads into scaling, because this is where it's tricky. Everyone wants to scale really fast.
So
if you were to scale, if we were to sell our entire company and start again, knowing what we know today, I think there's a really good argument for hiring third-party management.
That's my point.
But if you're starting from scratch,
first 20 space deal.
I think it goes back to what's the goal then. Because if you want to scale super fast, knowing what I know today, I would hire third-party management.
The other day that I wouldn't envy somebody starting out because of how much pain the management was.
But I agree with you that we have learned so much and understand the deals that much more.
We buy deals because we know what we know.
Totally.
I just want to make one quick point on this. We have analysts who underwrite, and we have financial controllers and bookkeepers who are in the day-to-day. And we often see underwriting can be a little rich compared to the real world perspective that comes from management.
I'd call it rich on income and lean on expenses from the underwriting side.
Right.
And then you go into accounting, and they're always leaning heavier in expenses and rounding down on the income.
Right. So I guess my whole thing is that comes from us understanding it. We have 100%. Both sides in our office.
Right.
If you didn't understand it, if you hadn't gone through war and battle, trying to process that and underwrite effectively, I don't think you would be as good. It would be harder to get great and perfect at underwriting if you had not been through the trenches. Yes, so that's just something I think is of value. Now we're talking about someone just entering the space. What are some best practices to avoid risk and prep for scaling?
Right.
I've said this. It's funny. This might be my new moniker, but hire a good attorney. Step one, always hire a good attorney.
100%.
It's a
stupid questions.
Yeah. Ask all the questions you can. The other thing is usually they're integrated. They know what questions to ask. They have all kinds of information. Also, state associations are an awesome place to start. Some national associations are fantastic depending on your business class. But like for us in manufactured housing, there's a lot of great associations and they sell books. Like we literally, I learned on risk. Books. I had, all kinds of things that were written by a landlord tenant attorney that gave you kind of the basics, the things that you should be doing, pre-written leases, things that you should be advising your property managers to be doing, best practices. Don't be a shuttle service. Don't borrow money. Don't work on their house without there's all these common sense that you see and you go, oh, of course. But if you don't know to have that conversation because you aren't having it in that moment, it's something that it's really invaluable and really important. So I think good attorney, working with an association, we're spending a lot of time and focus and getting better and better. But from the get, we've always had great insurance. Yeah, I was going to say insurance is a big piece. And knowing yourself. Aligning and asking the attorneys and making sure you understand the fine print in the insurance piece and what the exceptions are, and really honing in just so you don't get a curveball out of left field. Yeah. If we're talking about risk mitigation in all of these conversations, you should be asking the same questions, which are, in your experience from a professional standpoint, what are the problems you see in this asset class, right? And if it's utilities are a really big problem and you're in the underwriting stage, you should be spending time vetting and looking at the utilities. We talk about finding the safest deal you can. The problem when you first enter the space is you might have to buy a deal with a little bit of hair on it to be competitive and actually get a deal. Yep. And there's nothing wrong with that. We have another joke. The darker the berry, the sweeter the juice, right? Because some of these value add deals, if you're capable of doing it, you do have some of that upside. So 100%. If it's your first deal, we don't recommend you buy the mobile home park that's 20 spaces with one home in it and no utilities. That's not the goal. But if you find one that's 80% occupied.
In a great location.
But there's if it's in a great location, chances are there's something funny that you're going to work through. And there's a big part of value I feel like a lot of our value that we brought to the portfolio came from we were getting deals that we were getting because no one wanted to deal with the headache. And we brought that value. We earned that chip. And then that's what ended up rolling into other great assets for us. So
in a way, we're willing to roll our sleeves up and do what people don't want to do.
Right.
And we just pay a little bit more than they're willing to.
Can I add one more thing on the risk management that I think is crucial is the due diligence process. 100%. So before you buy the deal, pay up for the contractors or the engineers. Obviously, you're going to get a loan on it, so they'll have their own inspections. But go above and beyond that, scope the sewer lines all the way out to the mains. Have a GC go through, walk the units, look at the HVAC, look at the roof, and then they're going to come up with some things that are wrong. Get bids for that. And then you can then do a risk reward and justify that purchase price. And one, you can negotiate with the seller and bring that to their attention. But two, if they're not going to negotiate with you, you need to be comfortable with, because that's when you do that. That's the risk. How do you manage risk? It's right in that process.
Yes.
And then the reason why after you buy the deal on a 20 unit, because I was saying 10, 20 unit apartment, why I would do the property manager versus me just doing it is because then you could leverage their expertise and you could learn it and then decide whether or not, but they're lease agreements. These are legal agreements, right?
Exactly.
They know that the laws. You could then rely on them too.
Learn.
Yeah, rely on them too. Budgeting, right? They could do a lot of that budgeting. Not all property managers are. I wouldn't hire somebody to collect rents, but
Let's specify property management company versus a property manager. Yeah. Right. That's what we're talking here. Exactly. You're hiring a third party company to absolve you and manage the day-to-day operation on their own.
Yeah.
But they would collect the rents.
They would collect the rents as well, but giving you a budget, right? Yeah, Reserves, all those things.
They could teach you a lot.
They could teach you. If someone's just starting, it's give up the 4% of revenue.
Totally.
And learn the docs and learn the processes and learn kind of what they look out for and get kind of knowing what I know today. If I was brand new starting out, I probably would do that and and then I would study all the docs and all their processes
you gotta audit them.
Learn.
Yeah, you got to be on them.
Yeah, and then you would really kind of start to learn more of structurally how the deal functions and works and really creates that cash on cash return after it's being managed day to day. So it's an interesting
I do think
point.
I think there's a huge market that's there for that too.
And there's great third-party management companies
really
in multi. In manufactured housing, virtually non-existent.
I know.
Yeah.
It's just like the people that are out there are just not good at the space. When we were starting, like if you take a same 20 unit example,
right?
20 unit mobile home park, like man, good luck finding a good
Which
property
is why
manager
I think
for that.
we managed our own deals because there weren't any
Well, it was
good.
also survival for us.
There was one that comes to my mind, but
there were a couple, and like now hearing stories secondhand on like certain licenses that they didn't have and things like, wow. I'm saying there's a couple, I don't know which one specifically, but it's just one of those things where, in our space, it doesn't make sense. And yeah.
Well, it goes back to like, there's not that many deals for property management companies to focus on. Now it's kind of becoming more institutionalized to where there are these bigger shops that can manage effectively, but that is also larger deals. These mom and pop level 20 unit mobile home parks, still today, you're going to have a harder time finding somebody to do that work for you.
There's just not enough juice there. It's just
you made a comment about the property condition report, and I just started laughing inside because if we relied on a property condition report to do our due diligence, oh my gosh, so many deals would have been upside down because first off, usually they're hiring third-party inspectors that are not industry specific. So you might get an inspector that like inspects all types of assets, and usually they're not looking at infrastructure deeply at all. Like usually what we get from a property condition report is like, you need white paint on the street, lines for the parking. You need to paint the speed bumps. They're not looking at your utilities. So like make sure you're doing it.
Money. Plumber, a real plumbing company.
But it's part of the package. You got to have the property condition report. You got to have the contractors. You got to have all the utilities scoped or looked at because, pick the big dollar cost things that would be the most to repair. Definitely get those looked at. Yeah.
Yep. Yeah. We went super deep on this the other day, and it's fun because there's a lot to it all. And we just wanted to cover like the basics of these topics. And then, so scaling up. So, I'll lead because I did this for us in a way. And I think one of the biggest lessons I've learned is to make sure you don't outpace your ability to operate so that you don't have egg on your face with your investors down the road. It's easier to buy deals. It's harder to operate them well, and operate them within budget and do all that. And so I have a few industry friends that scaled up in, I'd say the kind of 10 or 20 year, my senior, and they've scaled up to 10, 20,000 units plus. And they would constantly tell me like, you know what, you're doing great. Keep pace. And as you grow, your scaling will get better and you'll start to grow at a faster percentage rate for your size company. And you don't really want to overscale on the buy side and the capital raising side if you can't operate because you don't want to lose a bunch of people's money.
Yeah.
Like that would be, it's like, you don't want to not take any risk, but you don't want to be stupid about scaling and go too fast.
Reputation and
like, at the end of the day, you embark on this 10, 20 year journey. It's not a 2-year journey. No. Your reputation is everything.
100%.
And so you have to do it at your pace. And honestly, we might be slower than some, we might be faster than others, but at the same time, like we haven't lost money on a deal yet. And I'm extremely proud of that.
Yeah.
What we're doing is hard. And I think when it comes to scaling, especially if you are running an operational management company, people take time. It takes time to develop good people that are doing their job. Even if you hire a rock star in your space, in your everything that they have to do within your company, it takes time for them to understand your procedures, protocols, all these things. And so it takes time to build up the team to make sure everything's running perfectly because you aren't doing it as you scale. You're going to start to delegate and hand off some of these responsibilities, and you need to have the person you're delegating to capable. Yeah. And that usually takes time. Yeah. So we know lots of operators who they take some institutional backing, they buy a ton of deals, and then we just hear, the sound of the coins falling out of their pockets kind of thing.
Sorry, I didn't mean to interrupt you. I just want to finish with this point, which was we just went to a conference. Yeah. We hung out with people that bought deals of ours that were institutionally backed. Long story short, they weren't the buyers. They just kind of ended up taking over this distressed fund that had other assets in it. So they pulled the mobile home parks that they bought from us out of it. And we're talking accounting and management with with them, and they use a third-party management company, don't they? They manage themselves. Anyways, not easy. As the bottom line was, they were not having a good time at it, and they were people that should know how, but they came only from the money side. And so they're trying to figure it out, but it's not been easy for them.
Interesting.
And the deals that we sold them are occupied and running still well, but it's like, it's when you don't have the context, that's why I could argue both sides. On the scale side, I'd be like full throttle, have somebody else manage it. But that's if you can find adequate management.
Well, and that's that was what I was going to say too, is like, it depends on what you're trying to do and what asset class you're in. Because you could scale fairly quickly if you're willing to get third-party management, you're willing to take private equity groups that'll back you and like your model. But we've chosen as a business decision not to do that. Like, we like the slow and steady. We want to raise private money. So it's just a different kind of approach. And so that's just would be my comment on that.
We've also focused on markets. We've picked MSAs and stuck there and built scale. And I think that this is another operational hiccup that I see a lot of times is they want to buy deals quickly. Well, if you're buying deals quickly, what ends up happening is you have to choose multiple markets. Mm-hmm. So then they're buying one asset in multiple cities all over the country, and they're losing the structure that it takes to really effectively operate. And so then you kind of start hearing like,
especially in the mobile home park space.
Such a good point.
Yeah.
And we've heard that. I've heard that many times from other operators. Blake, I know, has. They're like, you guys are so smart by just like focusing on markets and building scale, because it's so much better to do a focus strategy than a scattershot approach strategy.
Yeah.
Right.
Because to your point, like the operations, the efficiencies of scale, the ability to like have regional managers, the ability to understand the market and what's going on.
Yes.
It's so much better than on the exit. It makes it so much easier when you could package portfolios together in the sell.
Yeah.
It's so much more valuable too. Like, there's portfolios right now that are coming out, and I don't even think I'm going to make offers on them because I don't want these
where the properties
7 deals all over the country in markets that are unknown.
Yeah.
And untested, in my opinion. They're tertiary markets, and then they bolt on like 3 or 4 really good market locations. And it's like, well, I'll buy those for top dollar. But we don't want all of the other junk. And so they try to tie it in. And me and Michael, our acquisitions guy, we go back and forth that we don't believe right now is the time to try to sell a portfolio that is spread across a big geographic location base. You want to probably do little portfolios in the same region, or just sell assets one off and take the time, because there's going to be a good buyer for even the tertiary deals, but you're not going to get like a big price premium unless you get some sucker institution to buy them. Honestly.
I agree. I know we see those all the time. And that, to me, that's like, oh, portfolio. And you look at it and you're like, this is all over the place.
God, I'm always so excited to see them.
Yeah.
And then typically I'm like let down on where all of them are. And there's only 2 that we really like out of 10. And
well, we're touching this, and you kind of alluded to it early on in the conversation. When we talk about a good market and a good place to be, you want to have a strong MSA that you're going into. I think it's imperative that you actually physically go and see where you're going. Right? Because if you're on the outskirts of somewhere, what is the growth plan of that area? Mm-hmm. And are you in it? Right? If it's gentrifying, are you on the right side of town? Because sometimes we go and look at deals and you can feel that it's quiet.
Yes.
You can feel that it's slow. Well, if you're there and it's Saturday night and there ain't nobody around, there's no buildings being built, and you're 15, 20 minutes out of a great market, maybe you're on the wrong side of town. And maybe that's what it's going to look like when you're trying to occupy and lease up and improve, right? Because if you're raising rents, you might have turnover. If you have turnover, now you have to turn units. You have to turn units. Are you going to have a buyer? And maybe you're not. I mean, we've had this in our own portfolio where you can just tell. It's like, on paper, this deal looks so good, but it's not doing good. And then you drive out there and you're like, oh, and now it makes sense. I had to drive 20 minutes on this dirt road to get here, and it's not ideal. But someone in a boardroom looked at it, and on paper it looks fantastic, right? So you got to go out there. You got to physically see
boots on the ground and really get a feel.
What do you say, Blake? The best deals are what?
Always the best deals.
That's right. That's right.
We just bought a deal in Anna We all went out there. We were listening to Big X the Plug, Texas.
Drinking Dr. Pepper, baby.
And it was so funny because we got there and you could feel it. It was buzzing.
It was buzzing.
It was humming. Yeah. We crest that hill. You could see all the single family residential being built. We tie it up, and I think it's multiple billion-dollar residential contracts were awarded in escrow. It was like, you could feel it. You could sense it. That deal's worth more money in escrow. It was such a beautiful thing.
Love that deal.
But there was an operational risk associated with that deal, which detracted a lot of institutional, I'd say, institutionally managed deals too, where they had third-party management companies.
They don't have those. Yeah,
and I preached about how we've had to order homes for these guys coming in because they're afraid that their investment committees or their management operations on just the investment side are going to kill their ability to operate.
And I would say in our space specifically, there are those niches that we need. Knowing what we know today, I would manage our deals over and over. But if you were getting into multi or a different asset class, I would probably hire a third party.
I
but
agree.
Mobile home parks specifically have nuances that are very specific where you just really, it's better if you manage your own stuff.
Want to jump to news?
Yeah.
All right. The news section. All right. So the biggest, and we want to focus on real estate investing news, things that are relevant, could be economical data, kind of driven from like I think Ty's going to talk about some of the Trump tariff stuff, because it does, like, as we're doing data, I'd say an analysis and like diving into different markets, we go deep into multi and industrial and where business is moving, you know, like the whole semiconductor stuff in Phoenix. We're like, love all that stuff.
Yes.
So what was the latest news article you wanted to bring up?
Yeah. So I think for me, it was a conversation that I had with one of our investors who's a residential mortgage banker. And we were catching up and he was telling me about this deal that was going to fall through. He was trying to help out this young gal that was buying a condo in Mission Valley here in San Diego, good market. And he's like, I think the deal's going to fall through because we can't get Fannie or Freddie, the two largest residential mortgage lenders, agencies to get through on the loan because of the condo, because the HOA is underfunded and they don't have enough insurance.
So was she trying to buy a condo community or one condo?
Just one condo.
Okay.
Just one condo. And I was like, oh, that's interesting. Like, yeah, it's a nightmare. So we're kind of talking about this. 3 days later, in the Wall Street Journal front page, boom, that Fannie Freddie have blacklisted 5,000 condominium complexes, not individual condos, complexes.
Wow.
And primarily in California and Florida, because the HOA and the insurance is just under the insurable value. And so they don't want to take that risk, even though they're just providing lending on one unit. They assume it for the entire condominium. And it really comes down to that surf ride story that happened 3 years ago in Miami, where that 12-story complex collapsed and like 100 people died. And so ever since then, it's really shined this light of all this deferred maintenance, whether they're balconies or structural, all of these condos that are poorly managed from an HOA. They don't have the dollars in the coffers and they're underinsured. And so it was, to me, one of those eye-opening moments where it's like condos are going to be a tough place for folks that are looking to buy, sell, or, you know, a lot of people have them as rentals. I just think that is an area coastal where I would not want to be in personally. And it's a challenge with all of insurance, but it was pretty wild. When you have those big lenders step to the sidelines, that's going to drive values down.
Yeah,
okay, hold on real quick. How many condominium complexes do you think are in California and Florida?
Oh, gosh.
Probably
hundreds of thousands.
You said the news article said 5,000 units or buildings?
Buildings.
Community or condominium complexes. So that's 5,000.
I bet you there's
gotta be.
Well, I got Grok info right here. So it's a lot less than I thought. This is a bigger deal.
I was going to say maybe 10,000.
Okay.
I was going to guess, I was thinking 15 or 20,000.
Yeah, 20,000, I'd say.
Total communities.
Buildings.
So it does preface that it's hard data because there isn't a singular database, but they're saying in California, it's 3,400 to 4,000. and in Florida, 2,600 to 3,000.
So almost all of them.
It's all of them.
I kind of thought that's where you're headed with it.
That's kind of crazy.
And this was 5,000 nationwide, but California and Florida had the highest amount. And I think in California, I think it was like 1,700 or something like that. It was high. And in Florida as well. Yeah,
like Riverside, you're probably okay.
That's the one in Ventura County, the example that they talk about is Ventura County.
That's half of the complexes.
I mean, it could be coastal though. That's up there.
Well, I'm hearing it kind of in my neighborhood too, where this is happening on single family homes too, where they can't get enough insurance to cover so the lender won't make the loan because they can't get the insured value high enough.
And well, I want to just drive this home because Tide was asking some good questions, and it's a little bit like, what are you talking about? You know?
Yeah.
Well, at first I thought we were talking about the complex, and I'm just so used to the way we would look at that. So my first thought is, well, what's the issue? Okay, they have issues with, there might be structural issues and funding issues, but if you're putting new debt on it, you would just assume that you would underwrite that. You'd figure it out in DD, what needs to be done. Okay, that's going to cost $2 million, and we're going to make sure we boost insurance. But that's like us. That's in his head. He's trying to solve the global problem, which is what we do if we're buying an entire apartment community.
Right. That's why I was asking: is it one condo or is it the complex?
That's the trick. That's why it's very. I'm walking through this very specifically.
Yeah.
Okay. So this is, you want to go buy a beachfront condo in San Diego.
Yeah.
Okay. Not the whole building. This
just
isn't an investment. This is like, you want to go live at the beach. And most of the time, like if you want to have a beach property, it makes more sense to buy a condo than 100%. Buy a beachfront house for $10 million. You know, so you can buy a condo in downtown La Jolla and Del Mar,
there's beautiful
and these
ones.
Really great markets.
Yeah,
and you just, as a consumer, this is why it's a big deal.
Yeah,
as a consumer, you want to go buy a condo. Okay, so you tie it up, you make an offer through a realtor that has it listed. You tie it up. Now you're getting your loan because we have investors that do these loans.
Right.
And you're getting your loan, and the lender goes, okay, who's your insurance agent? Da, 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 da. You go get your insurance, and they go, sorry,
not enough.
We will not make a loan on this because this is one of our condo communities that's blacklisted. You cannot insure us the risk around this mortgage.
And it's even more, I guess it's even more profound where the lenders, even if like one balcony, like it's also like a collection of information. It's not just on that unit. Oh, we'll walk it, check out the balcony and everything like that. It's like this contagion risk. If there's one unit in there, exactly. If there's one unit in there that they can't get information for, or it fails a balcony inspection, they won't lend on the entire thing. So I was just looking up in California. There's already 700. In Florida, there's 1,400. These are complexes that are blacklisted.
So it's thousands of units.
So is it going to force?
It's 5,000 nationwide, but but
that's 2,000.
Yeah, 2,000
of 7,000.
No, but you're saying sorry, just to be clear, 2,000 buildings. So that's thousands of condos.
Oh yeah,
like tens, 20,000 condos.
So
these condos could be 440 units. I mean, a lot of these were condo conversions back in the heydays,
right?
And I think you brought up a point when we were chatting about it. It's kind of interesting because so the HOA also has insurance too, right? And they're underfunded. But if the fact is that rather than like an apartment owner owning something, right? They're gonna be an investor. They're gonna constantly like infuse capital into the building. But if you have an HOA, you're battling like, I don't want my fees to go up, right? Yep. You own that. No, we're not. So it's that push and pull.
No offense if you're on an HOA board, but you're a bunch of Karens. and what's going to happen is they're going to have to start thinking about this risk, and they're having emergency meetings right now.
Well, they're going to have to move. They're going to have to raise the HOA fees or do a one-time call of cash to fix the buildings to get it into a sellable.
There you go. Get it approved. If you're one of the non-approved, how do we get it approved? And the HOAs are going to have to step up 100%. And manage that flow of money from all of the condo owners, or else their values are going to tank.
Yes. Well, let's talk about
they're not sellable.
No, basically they're untransactable.
Exactly.
Yeah.
So mitigating market risk on your asset type, like the ripple is so big here because let's just say that 20% in California and Florida have just become, unfundable. What happens to the values of all condos in those markets? Because now some of them are worthless. So all of the surrounding condo values are now going to be going down. It's terrible.
Yeah. Well, and if you're in a condo that doesn't fit this box, then your value just went through the roof because
I don't think so.
You don't think so?
No, I think the perceived risk now.
Oh, coming. That makes sense.
Like I wouldn't want to go buy a condo now knowing this.
Insurance is already a problem. We have a lot of clients that are selling basically fire selling condos for the last few years because their insurance has doubled, tripled through the HOA. Because you're unable to buy your own insurance, it like gets tied up into the HOA, and then you can maybe buy a supplemental depending on the HOA. So there's a lot of complexity around the insurance, and I think that's the whole complexity of these like boards and these people voting on it is why the lenders are like, you know what, we're out.
Well, and they're trying to keep costs low, and they're trying to keep things more affordable, and they don't want it. Well, this is where you end up then if you don't maintain the building, and it causes major risk and unsafe environment.
This is brain cancer for condos, because if you have a truck, let's say you've got a lot of people have or let's use Tesla. This is in the news right now, right? Right now there's a lot of people setting fires to Cybertrucks. Right. I would assume that's going to affect the value on purchasing Cybertrucks.
Yeah.
If
I would probably buy a cheap used one now. I've always loved Tesla, Elon, just from just who they are. But now it's like, heck.
I'm just saying, if my wife came to me and said, I want to buy a Cybertruck, it's going to affect the value if there's a chance someone might light it on fire. Yeah. It's the same thing with the condo.
It might get hit with a Molotov cocktail.
If you're thinking, I want to buy a little investment, do I get a small single family house? Do I buy a condo? Do I buy a mobile home? What am I looking at? Condom would be out for me right now. It's out.
Wait. Good thing you made it bulletproof.
I know.
Freaking needs to be bulletproof right now.
Man, I'm on X, and some of the stuff that's on there is so terrible. These people, I think if you have a Tesla, I have a Tesla. I love Tesla. I'm sorry that this is happening to Cybertrucks. It's not fair.
I think it's cool. Just in the moment, it might be a buying opportunity for Teslas because the cars themselves. Because they were expensive. Now they were already trending down. Now you're like targeted if you drive one to where they're even going to go lower. I mean, they're getting to where they're like Model 3s are getting to like where they're the same price as a golf cart.
You could. So Tyler and I have golf carts.
Golf carts here, but
golf carts got to like $20,000.
I know.
Just for like a new Easy Go.
6 seat.
I think just putting this here, if you're in the markets, this is my projection. Tesla's like 40% down since January. Mm-hmm. I think it's a huge buying opportunity. I think that guy, he's so smart. I think the company's
buying stock.
Yes, it's half value
I wasn't
right
sure
now.
How far it was down.
Yeah.
Yeah, I mean, on paper that is a really productive company, but because of social perception, its value's been cut, and I think it's a buying opportunity. But anyways,
any other news to report, guys?
There was. What was the second one?
Oh, well, a couple of weeks ago we were talking about tariffs and just kind of walking through the different ideas going around. And Tucker Carlson had, what is it? Bob Lightfeld or Leitzer, Bob Leitzer, I think it was the name.
Yeah.
And he's the guy running in trade policy and tariff policy for Trump. And I think it's really interesting, his points. It touched a lot of the things we covered. And I think it's a real philosophical change where you've taken economics at university. They talk about this utility, idea where if you're offloading your production to other countries, you're getting it for lower. That makes it so you can drop prices. So now your consumer gets a better deal. You sell more. You make more money. It's a win for everybody, right? Mm-hmm. But what they're talking about is how through the production is where a lot of the innovation comes, and that's where a lot of the value in our companies are. And we basically push this, all over the place. They estimate that it would cost $20 trillion to the American economy. And that's what they're really focusing on, reshoring. And it was a really interesting perspective. And I know we kind of kick things back and forth. They do sound like they think there's going to be some minor disruption in the beginning, but they're expecting some really big booms. And ultimately, if we're reshoring jobs that are high paying in manufacturing, I just heard Rolls-Royce is doing huge. I think they're hiring it's either 600 to 6,000 people. They're building the new Honda Civic in 2026 in the U.S. There's a lot of things, and these are building, lots of jobs, more money in the economy. So that was an interesting kind of update from our last economic conversation we were having.
I thought what was really interesting, I haven't listened to it, but talking about a lot of the innovation is done through production, which makes total sense. If you're working on something, you're going to constantly be trying to rejigger how to do something better, faster, stronger, and more efficient, which I thought was an interesting point, because going back to like that econ point is that globalization or like offshoring, like manufacturing to make goods cheaper, allows people to increase their value, which is in econ called utility. They have more utility. Free, they could buy that t-shirt, buy 2 of those t-shirts, they have more variety, right? So which it makes them happier, but then they also have more time. And then the argument in econ is you have more time that allows the country that is less efficient or cheaper of producing goods to then focus on innovation. So it's like, we
aren't innovating. We're becoming social media managers over here.
And there could be an argument of like, no, we've been more of a service economy and look at like, the innovative companies that have come out of Silicon Valley and all of that stuff. Right. So there's another argument as well, but I just haven't heard that argument, which I thought was cool.
Yeah. And he covers that. I think it's a university, and I'm really paraphrasing this. It's a great watch. So go check it out.
It's Tucker Carlson's channel. Yeah. And it's Bob Leitzer.
Yeah.
Along those lines.
And so he references there's actually a college in, I think, Melbourne in Australia that tracks, it's like something like 60 different qualities that they look for in countries on innovation. And 20 years ago, America won all of it. And now we're behind China. And of the 60, it's like there's 2 that we're keeping a pace with. We're behind in a lot of innovation. I know that we all love Silicon Valley, and there's been so many neat things that have come from it. But that was a spooling of a lot of time from the Reagan era, all these policies leading into the internet boom, leading into all this wealth production. And I feel like that juice has now been squeezed. In America, like, we have to innovate. We have to bring back high paying jobs that create the kids that don't have to bust and grind and have that opportunity again. Right now, I feel like we're kind of going into that, soft time that's making soft people that aren't working hard and driving that American ingenuity that we have become famous for. What America is seems to have floated away, and that's a personal opinion. That's not necessarily the opinion of everyone on this panel, but that's just something
like the fourth turning conversations. The guys that wrote that book, it's really
scary.
Good. He's on PBD. He's been with Tony Robbins. Like, that's a great thing to look up to, is the fourth turning. It coincides with all that.
Yeah. It's a book.
Basically, like, it was a book. It's a huge data book, though.
I'm ordering it right now.
You're better off, in my opinion, to get a snippet of what they're talking about is just listen to some of the interviews. PBD, Patrick Bet-David just had him on maybe a year or so ago.
Okay, cool.
And it's an economic concept, so it's timeless. So you can watch the last few years of interviews of the same people, and it's really quite simple in theory, which is weak people, end up creating a challenge for themselves. You don't have a lot of production, so you're forced into becoming tougher. Let's say this hypothetical person that goes to college, has a bunch of debt, doesn't get a good job because it's hard to get a good job. Now they have a bunch of college qualifications, but they have no real life experience. Yeah. They're going to be challenged through like the next 10 years. And so that's where there's a lot of like this identity issues and all these confidence issues that come from that. So then they go out, they're the soft generation. Let's say food and survival is really easy. So then that causes them to be soft. Well, that creates hard times economically. And then from that standpoint, you have another cycle, 10 or 20 years.
Hard times.
Those hard times create strong people. Thank you. And then from there, the strong people end up building something great again. And then you go back.
Makes it easy. So then it creates that soft people, because when it's an easy economy.
It's fourth gen. Basically, it takes 3 to 4 generations. And that's the fourth turn. Is like our parents' generation were super tough. Yeah. It's World War II, early 1900s, World War I, World War II. They have kids.
Spanish flu.
In the 1940s and 50s and 60s.
Yeah.
The greatest generation had our parents, and so they grew up with a thriving, the people, like their parents had to work for it. They struggled, build something really cool, great and cool, an economic hub. And then they sort of started the turn, and so then like what's up from us, Gen X, is like 40, 50.
Yes.
We're mid-30s, everybody.
Yep. Gen X and baby boomers.
So our parents were the boomers.
Yep.
Then the Gen X kind of got the turn.
Mm-hmm.
We are the millennials that got, at least we didn't have an iPhone until we were like 18.
Yep.
Right.
Yeah.
So we didn't have the information and become such computer oriented so fast.
Mm-hmm.
Yeah.
And so we're on the cusp on the downhill trend into soft.
Yep.
I'm sure they would all argue that. And then our kids are the ones that are going to be challenged. But our kids are maybe even the generation significantly after the current Gen Z.
Mm-hmm.
And the Gen Zers are the ones that grew up with iPhones too early, honestly.
Yeah.
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 Like our challenge is going to be not giving iPhones to our kids too early.
Yeah. My 5-year-old's already asking for one.
It's
Nokia flip phone.
Our babysitter, she's
Yeah.
16 and comes from a good family, and she's got a flip phone, and it's interesting. Like, she has to send multiple text messages because she's on T9, and so they only have so many characters per text message.
That's awesome.
Oh my gosh, that's cool.
Seems well grounded.
She can talk to you, and there's not BS behind
Yeah,
that.
and I think the general premise of this economic conversation is there's a lot happening right now, and I feel like they're really trying to test the bounds so that we don't have to go through some hard stop fourth turn. And I hope they win, right? The whole world should hope that.
Trump is trying to throw a Hail Mary.
Yeah.
Yeah.
You know, I'd say in general, that's what's happening. And you're seeing the rats come off this thing. It's unreal. I mean, it's true. It's crazy. I never thought they'd be burning Teslas, honestly.
Yeah. Mind control.
Yeah, I think in general, it's a good time. Like, we're living through history right now, and it's a good time to be an optimist, like being optimistic, right?
Yeah.
Like, we have enough.
Trying to get into hard assets.
Yes,
and
get into hard
buying
assets.
Hard assets and enter the space however you can if you're wanting and desiring to do that.
And I think the stock market's going to be really choppy for a little while, and Trump knows it, and everyone knows it. But they got to change. They got to move
all-time highs. You know, like it's still in the top realm.
Yeah, it's fine, but I think we've all gotten used to 20% plus returns. Not, everyone's gotten used to the stock market.
That's the standard base hit.
Yeah, exactly. Continue to rip. Like, I was just, and maybe we could end on this. I was just having a conversation with a potential investor, and we're talking about, like, this investment returns and all that stuff. He's like, well, I get like 15% from my Morgan Stanley account every year. I was like, 15%? Like, what are you investing in that's cash flowing 15%? They're like, no, that's just like the returns every year. I'm like, yeah, but that's not guaranteed, right? Like, it's just maybe been the historical returns over the last couple of years.
Only for the last couple. He's already thinking that it's normal.
But exactly.
Every year for the last 10.
But it doesn't always act that way, right? But I just thought it was interesting the way that he said, like definitively, like, I get 15% every year, so 12 doesn't sound that exciting to me, or 14, and it's liquid. But I'm like, yeah, okay, yeah, I got it, because there's no reason to argue. It's like, it's like, understood, and I get it. That's not guaranteed, and when you sell it, you pay taxes on it, right? Obviously, but I just thought it was interesting.
There's a good argument for diversification and the tax benefits of real estate, and that's where I think it's kind of a hardcore line between, or like a T, where it's either the real estate guys, you either have a real estate mentality or you have a stock market mentality.
Yeah.
But we all should try to diversify into each other's investment schemes, investment platforms.
I agree. And I think the best people do a little bit of everything.
Yeah. And we have a bunch of friends that do and love both, and then know how to play the real estate tax side, because that's where the stock market guys don't even understand how do people like Trump, like real estate billionaires, how do they get there and not pay the taxes? It's all depreciation. Yeah. I think that there's an argument to say that we've learned the tax code in a little bit deeper, different way than when you just leave your money in the market. They don't want your money out of the casino. They want that money in there.
What's the saying? A jack of all trades is a master of none, but a master of none is still better than one. The whole point of the actual original phrasing is that if you're a little bit good at a lot of things, it's better than if you're really good at one thing. I think it's like an old trades comment.
Jack of all trades, master of none, which is often used to describe someone who has the broad range of skills but isn't an expert in any single one.
But what's the
full original saying is actually Jack of all trades, master of none, but oftentimes better than a master of one.
I was on.
That was pretty
got
close.
it for the most part.
Maybe we'll leave it there.
Yeah.
We'll leave you there. Yeah, we wish you the best. Thanks for joining us again, and have a great rest of your week. Cheers. See ya.
Bye.
Thanks, everyone.